It's Lee here from the Customer Success Team to offer you some tips on entering base expenses in your projections. Here we are on the brand new expenses page under Scenario Setup. You're probably used to referring to base expenses as the after-tax spending value. We've changed that name to provide a bit more clarity now that we've added another category called additional expenses, which I'll discuss in our next video. So base expenses consist of an annual amount for recurring lifestyle costs, such as groceries, transportation, home maintenance, and so on. Your editing of the base expenses value will mainly take place on the planning page, but you have the option to enter an initial value right here on the scenario setup. You might be wondering if a budget for your clients is required to create the projection, but the answer is no. You don't need to know the exact base expense amount right away. In fact, we can leave this as 0, just not blank, to start with. And once you reach the planning page, we'll have a few options to determine what to enter right there. But perhaps your clients do have a budget. If so, it's worth noting that for the purpose of coming up with a base expense value, you'll need to exclude from this budget those items that will be entered separately in the projections. For example, debt payments, insurance premiums, asset contributions, which will be done on the planning page. And then the remaining amount can be entered as the base expense. Once we get out to the planning page, that base expense value is displayed for us under the base expense column for the real dollars at the point of the CFM start age. So for this couple, they're retiring at 65. That's the year the CFM start age defaults to, and that's the year that we see the consistent level of base expenses that we entered under scenario setup. We can make changes to that by changing the start age. If you had a retired couple that you're doing a plan for, you'd be able to enter their base expenses right from the beginning of the plan. Now, if we didn't know the base expense value, so if I had left it at 0 and then come back out to the planning page, how do we know what to enter here? So there's a couple options. First, we can take a look at the initial base spending. So in the first year, after the expenses that have been set up, after taxes, after savings contributions, what's left over for this couple is $114,888. Using that as a reference, we could say they want the same lifestyle when they retire, or we could give a percentage like we did before where we said $84,000 was their lifestyle budget in retirement. Note that once we put that information in, that it's indexed with inflation automatically under that nominal dollar column. This is the combined amount, which is automatically split between both spouses. Another way to come up with the base expense value is to use our recommendations feature. Here we can apply sustainable spending to have the software calculate for us a maximum level of spending that is sustainable so that they don't deplete their capital assets until the final year of the projections. We apply and run that value, and back on the planning page, once that's been applied, we see that populating our base expense value. This is editable in any given year, so you can adjust it going forward in time. Back under Scenario Setup and Expenses, we're no longer able to edit that base expense amount because we've made the changes on the planning page. We'll need to make adjustments from there going forward. So please join me in our next video where we'll talk about additional expenses.